This is a perfectly diversified Dubai real estate portfolio that generates over $100,000 each month. And it's much more complicated than you think. But in this video, I want to make things easy, and I'll share a guide how to build a successful Dubai real estate portfolio that generates millions of dollars each year, that is perfectly balanced, and that thrives in all the market conditions. And it all starts with challenging the popular belief many investors have. Building a real estate portfolio is not the same as just buying several different properties. Here is a quick example. A list of 3 different properties. 3 one-bedrooms on different floors in Binghatti Corner in GVC. Is this a diversified portfolio? Obviously no. But let's make the things a bit harder. Here are 3 different options. 3 different sets of properties in Dubai. Number 1. 3 one-beds in Binghatti Corner. Number 2. 1 bed in Binghatti Corner, 2 bed in Oxford 212 by Imam, and a studio in Westwood Grande by Imtiaz. Option number 3. 1 bed in Binghatti Corner, a studio in 1 Beverly by H&B, and a 2-bedroom in Cove Edition 5 by Imtiaz. Which one of these 3 is a diversified portfolio? I'll give you 3 seconds. 3, 2, 1. And the answer is none of them. So let's discuss what is a diversified portfolio. You want to diversify and invest your capital in several different real estate assets, because if it's all concentrated in just one property, you become exposed to an unnecessary risk. But having multiple units, even in different buildings, even of different sizes, and even in different areas, is not enough. True diversification means allocating your capital to different risk and growth drivers. This is the way how you get assets that show independent performance, meaning they're not correlating with each other. If revenues from one property go down, another one keeps growing and keeps performing well. That's what you want to achieve, right? You want to achieve independent performance. So diversification is non-correlation. Even though you won't get perfectly uncorrelated assets in real estate, because we're talking about a specific asset class, properties, a specific market, UAE. So by default, there is correlation, but you can build portfolio in a way that you decrease it. So what you need to do is to combine several things. Different property types, for example, apartments and villas. Different areas with independent supply and demand drivers. Different purposes. Some properties are better for generating cash, and some are better for growing in value and delivering value appreciation. Different levels of maturity, and finally, different target users. So to make your life easier, here's the matrix that simplifies everything. Lines are different target users. So on the left you have 3 different user groups: businesses, residents, and visitors. Think about that. Offices, villas in residential communities, and apartments in touristic areas. All of them have different growth drivers. Number of new businesses in Dubai, number of residents moving here, and number of tourists visiting the city. They have pretty different reasons to grow. That's why ideally you need properties in all 3 categories. And columns are risks and returns. Lower risk and lower return, and higher risk and higher returns. Now we have the matrix, so it's time to fill it in. What do you fill it in with? First, businesses, lower risk. In this category, we have ready offices and ready retail spaces. They're already generating cash, so if you've done your analysis right, you can easily predict the future returns. Next, businesses, higher risk. Here we obviously have offices and retail spaces at the off-plan stage. These properties will not generate cash right away, they will only after a few years, but the value appreciation potential is much higher in this category. Next, residents, lower risk. To fill in this quadrant, you go for properties by reliable developers in matured areas. Both ready and off-plan are fine for this category, because you invest in a matured community where everything is predictable and you're buying from a developer that is known for delivering on time and delivering a certain level of quality. Next, residents, higher risk. Go for off-plan residential units in early-stage master plan communities. This is how you maximize the returns. You enter the community at the lowest price point, the developers will launch new projects, the community will get more developed, and this will push the prices up. At the same time, the community is not there yet, so your risks are higher. And the next one is visitors and lower risk. So here we go for areas targeted at tourists or business travelers. And in these areas, you're looking for ready apartments. I personally think that right now, at this stage of the market, the lowest possible share of your portfolio should be invested in this category. Probably even none. Because in the best case scenario, these areas, they're appreciating in value in line with the market. And most properties there, they're not generating really high yields anymore. So to target visitors, let's go to the right bottom quadrant. Visitors and a higher risk. Here we have off-plan apartments in future touristic areas. So these areas have no tourists now, but they will have in future, and they will compete with other developed areas throughout the city. So next, I'm going to share some specific properties that will work well for different quadrants of this matrix, and will show you how the perfectly balanced portfolio might look like. This will be a bit of a generalistic portfolio, and if done properly, you should take into account your risk appetites, you should take into account your financing options, and other factors that affect which properties you go for. So to help you out, we created a tool that helps you assess your own real estate portfolio. You can use it for the properties you already have, or you can use it for the properties that you're thinking about investing in. So the way it works is that you fill it in with the properties, and then the tool assigns them to different quadrants of the matrix. You get a score that shows how well balanced your portfolio is, how diversified it is, and how well is it designed in terms of risks. If you want to get this tool, you can get it for free. You should scan the QR code or click the link below the video, and someone from my team will send it to you. And we're sharing it for free with everyone, both brokers and investors. Now, let's go together through different quadrants of the matrix, and I'll share some examples of the property that might fill well your portfolio. The first is business category, and if you have the budget, you should absolutely have these kind of properties in your portfolio. Dubai's office market is rapidly growing, around 60% increase in value over the last 3 years. The supply is super limited. The planned future supply will grow the overall supply of offices by just 16% by 2028, and most likely they will fail to deliver all the properties on time, so it will be even less than that. At the same time, the number of businesses in Dubai is actively growing. 40,000 new companies were registered here last year, and the total number of businesses in Dubai is gonna grow by 40% in just 3 years. I'll show you one chart really quick. It illustrates the vacancy rates for different office types. Prime offices, Grade A, Grade B, and Grade C. Vacancy rates at historically lowest numbers. But what's remarkable is that for Prime and Grade A offices, there are just 2 and 3.4%, meaning there are almost no free offices in these categories at all. So for those who want to get offices in their portfolio, I highly recommend going for Prime and Grade A towers. For ready offices, one of the most demanded areas is DIFC, Dubai International Financial Center. A 3.1 thousand square feet office will go for around 21-22 million dirhams. This type of property will generate approximately 7.5% net rental yield. And DIFC, as a free zone, is going to remain one of the most demanded in the city. Developing the financial sector is on the Dubai's economic agenda. It's going to significantly increase in size, so we expect that much more office space for financial companies is going to be needed in Dubai. But one important thing you should take into account is that DIFC is growing and there is going to be DIFC 2, so the supply of this free zone is going to increase. Now let's go to the high-risk category and look for enough planned property. And here, to balance things out, I would go for a property in the mainland. One of the most interesting projects right now is House of Tanet in Business Bay. 14 million dirhams will buy you a 3.5 thousand square feet space, and we expect it to generate over 1 million dirhams in returns, which is around 7.5% in net rental yield. So this building is especially interesting because of its unusual concept. This is a Grade A office, obviously, and 20% of the space is dedicated to their amenities. They also have an interesting concept of a garden floor. They have pretty good views, and we think that this building will stand out in its area. Next, residential category, lower risk. When we talk about low risk, generally Ellington comes to mind. They're quite predictable in terms of delivery timelines. Their quality is predictably great, and sometimes they choose developed areas for their buildings. If you haven't seen this before, here is a chart with quick stats on how Ellington performs compared to the market. Here are their buildings in GVC, almost all of them perform better than the area's average. And the one that doesn't perform better is now surrounded by construction projects, so most likely it will too. One of the suitable projects by Ellington is Altira Views between GLT and Jumeirah Islands. What they're gonna deliver there will be one of the best quality in GLT area. So if you're looking for reliable investments, it's one of them. One bed there is 3.2 million dirhams, and we estimate that it will bring you around 6.5% in net rental yield. Another pick here is Ellington Hill Gate in Dubai Silicon Oasis. And this area is somewhere in the middle. It's kind of matured area, there are many buildings there are many offices there. So we know the real transactions, real rental rates, real sales prices, but there is an interesting thing with this area. In 2029 there is gonna be a metro station. It's a big infrastructural development and most likely it will push the prices up, both the sales prices and the rental rates. You can get a 2-bedroom there for roughly 2 million dirhams, and conservatively, it should bring you 6% net rental yield. Next, I would definitely add something from Iman to our portfolio, because Iman is definitely one of the best developers in Dubai in terms of rental returns. Here's the chart with their rent to initial price ratio, meaning those who invested at the off-plan stage, how much returns do they make now when they rent it out. And they all are between 10 and 14%, which is really high. So their main new project right now is Sierra. It's located in Motor City. For 1.3 million dirhams we can get a 1-bed that will generate around 7% net rental yield. But what's also interesting with Iman is that their ready buildings still generate high rental yields. And if we go for something ready, I would probably search for it in Arjan. In Arjan they have their building called Oxford Gardens. A 1-bedroom can be bought there for roughly 850,000 dirhams. You can conservatively rent it out for 55,000 dirhams and get up to 7% net rental yield. And let's add the last one to this quadrant, Sol Levante. Sol is an amazing developer. They've delivered more than 200 projects in Dubai as contractors, so they're very experienced. They're delivering pretty good quality, but they're not that hyped in Dubai. That's why their properties are attractively priced for what you get. So let's say we want to get a studio in Sol Levante. Then for 760,000 dirhams, we can get something that will generate conservatively 55,000 dirhams in rental returns. That's a 7% net rental yield after we deduct the service charges. So we're done with lower risk residential properties. All of them are targeted mostly at rental revenue, so they are great for generating cash flow. Now let's discuss the high-risk category, when we have much more opportunities to grow our capital. And the project number 1 here is the new villa community by Nahil. They are building this community on Dubai Islands, on a separate island, Island E. So it will be basically an island fully dedicated to villas. We think it's an amazing opportunity for several reasons. First, villas are crazy demanded in Dubai, as well as waterfront properties. Both of them grow very fast, and when you combine those two and get villas on the beachfront, you get a very powerful investment. Number 2, preliminary prices that were recently announced are pretty low compared to everything else similar built in Dubai. They are not final. They may change because there is still some time until they launch this community, but still it indicates a lot of room for value appreciation. And number 3, Nahil is an exceptional developer. Exceptional developer for both those who are looking for long-term value generation and for those who are looking to quickly flip the property. There were cases of flipping their villas on Dubai Islands, the community they previously launched. So there some of the owners managed to resell their properties with around 20-25% markup in around a year after launch. And if you take a look at their villas or residential buildings that are built 10 or 15 years ago, they still keep growing in value. So in this area, I'd go for large villas, let's say a 5-bedroom. The preliminary price is around 17.5 million dirhams. Again, it may change, but if the price will be around 17 or 18 million, you can expect 7% net rental yield. And may I remind you that this type of property is first and foremost for value appreciation. Next property in this category, we want to get in Dubai South. Dubai South Residential District to be precise. This is an area right next to Al Maktoum International Airport, and this airport is the main reason why we have this area on the list. This airport is gonna significantly expand. It's gonna reach a capacity of 150 million passengers by 2032. This will create a lot of new jobs, and people who will work there and work around the airport, they will need some places to live. We understand that this will create a huge demand for affordable housing, and those investors will win, who will invest in projects that will stand out. Imtiaz just announced a new project in Dubai South, so you might want to take a look at this. Also, Avenue is launching new phases of their 888 residential complex. And if you go for 888, for example, then for roughly 900,000 dirhams, you can get a one bed. This is a very low price in Dubai. You cannot find prices like that in other areas across the city. So this is a classic example of a value gap property. Even if the market doesn't move, it will appreciate in value. And also the rental returns are gonna be good. We expect around 6.5% in net rental yield. And finally, the third project I want to add to this category is a new launch in Gulf Woods. Gulf Woods is expected to be a super green residential community. They're gonna plant 35,000 trees, which will make it the greenest area of Dubai. Prices there are still lower compared to other green areas of Dubai, and to get a 2-bedroom in their new launch, you need around 3.2 million dirhams. You can expect 7 to 8% net rental yield from such an investment. So let's take a look at what we got. We allocated 21.5 million dirhams into a low-risk office space, roughly 14 million dirhams into a new off-plan office, 8 million dirhams into residential apartments in different matured areas, and 21.6 million dirhams into early-stage high-potential properties targeted at residents. Now let's discuss the next two quadrants. Here we discuss properties for visitors, tourists, and business travelers. I would completely ignore their low-risk category, because as I said, the returns are pretty low there at the current state of the market. But for higher risk, for the new areas, there is only one area to be. One of the main touristic areas of the future Dubai is Dubai Islands. It has a 21-kilometer open water beach, a better beach compared to Palm Jumeirah. It'll have a huge mall, almost as large as Dubai Mall. It'll have a golf course on the seaside. Also, it'll have a huge artificial reef in front of the islands. The latest update was that they fabricated roughly 40% of all the units, so we expect it to be launched somewhere in 2027. And finally, Dubai Islands will have a huge number of hotels. They will increase the attractiveness of the area, the prestige of the area, and they will bring a lot of amenities, spas, entertainment parks, and a lot of dining options. If we don't take into account Island E that will be dedicated to Nahil's villas, then investors have two main options, Island A and Island B. Both islands can be pretty good, but we advise most of our clients to invest in Island B, because there you can get properties with a private beach. So if you invest in one of the new properties there, then you can get a property with a private beach on the first beach row, with sea views, golf course views, sometimes even sunset views. So these apartments are going to be super demanded. And generally, residential buildings that have direct beach access, they're performing pretty well. The thing is that traditionally, most of them were in the luxury or ultra-luxury segment. And here are some stats with their historic growth. Some of them are not just beachfront properties, not just with a private beach, but they're also serviced, built in collaboration with luxury hotel brands. And one of the projects like that, with a similar concept, is coming to Dubai Islands. It wasn't publicly announced yet, so we're not sharing any information online, it's for our clients only, but it's gonna be launched soon, and we believe it's gonna be one of the strongest investment opportunities in Dubai. Some other good examples that were recently launched are Siora by Beyond. Most of one-bedrooms here were between 2.5 and 3 million dirhams. And let's say we go for a 2.9 million dirham unit. Then we expect more than 8% net rental yield. And there were also several projects by Avenue, also very strong concepts, on the first beach row with a private beach access. Their main feature is that they're a boutique. Normally, they had less than 100 units. So those who invested there got tremendous competitive advantage, very strong leverage, so they'll have a chance to charge massive premiums. So let's take a final look at the portfolio we just designed. The total capital needed for a portfolio like that is around 75 million dirhams. That's roughly 20 million US dollars. And that's what you need to generate over 100,000 US dollars every month from Dubai real estate. Now when you know the approach, you can make your property investment search more targeted. Focus on properties you need most according to this matrix. One of them can be right here.